We're joined this morning by Fook Hien, the Senior Investment Strategist at Standard Chartered Bank. Thank you so much for joining us this morning. Overnight, we've seen bond yields spike and we've seen the Fed minutes come out. Can you tell us why there is so much volatility in the bond yields, and what would you take from that? What does it mean for risk assets?
Yeah, thanks very much. I'm very happy to be here. So, bond yields have been a big driver for the market. We've seen that last year. There's been a lot of worries about inflation and whether they'll be controlled or not. So we think the market will continue to be volatile. But our view for this year really is that inflation will be able to come down and it will be controlled. And this will actually pave the way for the Fed in order to cut interest rates at the second half of the year. So for the first half of the year, I think we're looking at the momentum continuing for the economy, and the yields have been coming down. But we do expect that as inflation comes down for the rest of the year, that the Fed will be able to then cut interest rates towards the back half of the year and be able to support the economy as more signs of weakness come through. So I think the Fed is in a difficult position. In December, they surprised with a bit more of a dovish stance, pointing at 3 rate cuts this year compared to where the market was expecting. So I think it was now they have to drive a fine balance in terms of keeping the view that interest rates will be finely balanced in order to support the economy. And so our view is that the Fed will be cutting rates towards the back half of the year, and they'll be supportive for the economy.
I was reading a recent report that states, and this is JP Morgan's latest Treasury Client Survey, which showed the biggest net drop in long positions in bonds since May of 2020. And that's led by both a reduction in longs and new short bets. I'm just trying to understand the direction that bond yields will take right now. And we're watching this very closely from India because invariably this affects risk assets in emerging markets as well. How are you reading that?
Yeah, you're right. I think the question of yields is that it drives a lot of things. It will drive FX as well, which will then impact the emerging markets especially. So I think there's a lot of focus around it. I think the yields and the expectations about it move around quite a lot. As you said, it moved last night over 4%, and then it's dropped down below. Our view is that over 12 months, it can slowly migrate down towards 3.5%. Now, a lot of this is predicated on inflation coming under control. Our science is that inflation will come down. The core inflation, the services element, a lot of it is supported by shelter or your housing and rental equivalents. We think there are signs there already in place that shows that the inflation there will come down and it'll come down. But bear in mind as well, history suggests, especially in the 80s, that when inflation tends to be high, it is very difficult for it to come under control. It can be very volatile when it is high. And therefore, the Fed, they're looking at history as well, and they are aware that you cannot be complacent at all. You've got to be very, very careful about inflation. Therefore, they're also sending the message that rates will be high in order to control inflation. So we think the messaging is consistent. They are very, very careful. But our view is that at the end of the day, there are signs that inflation will come down. And as that comes down, historically, it suggests that the rates will be able to come down and the yields will come down as well following that.
Last question, Fook. I was looking at some of your interviews last year as well, and you had initially thought that there would be a recession in the first quarter, and I think a lot of people thought that at the time, but that seems to have gotten pushed forward. In fact, some Fed officials are also talking about the possibility now increasingly of a soft landing. It's not inevitable, they say, but it's possible. What are your expectations, bearing in mind everything that you know now?
Yeah, thanks for that. It's true that we did have a view that a recession would be coming, but then like much of the street, I think we've been proven wrong. So our view at the moment is that we think the base case, our view is that they will have a soft landing. What does a soft landing mean? We think that for the majority of the year, growth will be below trend, but positive in the US. So that's our view of a soft landing. And in terms of a recession coming in, we think we're okay for the first half of this year. But a lot of indicators, your traditional indicators of recession, like your inverted yield curve, that remains in place. So we're very cautious as well about whether a recession could come in the second half of the year. But for the first half of the year, we're positive about risk assets. Now, in terms of a recession coming on in the later part of the year, we think we'd be cautious, we'll be watching the signs about that. And our view really is about the 30% probability that you could have a recession or a hard landing coming in the second half of the year.
Thanks so much, Fook, for joining in and for sharing your views this morning.